Welcome to our first episode of the Integrity 365 Financial Insights podcast for 2024. My name's Sophie Haslehurst and I'm a Chartered Financial Planner at Integrity 365.
And I'm Debbie Packer, very proud to be alongside Sophie today, and I'm one of the founding financial advisors at Integrity 365.
So we're recording this on one of the last days of January as we get very close to the tax year end, and it does seem to be the topic of conversation with a lot of our clients at the moment and our professional contacts as well. So we thought today we're going to focus on what is everyone talking about and what are the sort of main points that we're really focusing on before we get to the 5th of April. I think, Debbie, the first point to note as far as this is concerned for this tax year is the fact that our tax year end is a little bit earlier than normal.
Yeah, it is. I think clients obviously feel that they've got until the 5th of April to make their tax year end contributions. However, with Easter being early this year as well, a lot of providers are closing their doors a little earlier than normal. So realistically, everybody should really have their planning lined up for the end of February, very, very early March at the latest.
Yes, which when we say the tax year end is the 5th of April might be a little bit surprising for people, but I totally agree. I think with Easter at the end of March, it's just going to be a bit of a nightmare if you leave it to the last minute. So I think the key starting point for our conversation today is be prepared.
Absolutely. Yeah, and that's a great lead in actually, Sophie, because I think what we need to look at is what are the key allowances that finish at the end of tax year. Because obviously a lot of things run throughout the whole year, but with everything in terms of market volatility this year, I do get the sense people have maybe been a little bit reluctant to put funds into the markets while we've had that sort of period of volatility during 2023, and may have been waiting until the last minute to make their investments into their allowances.
Yes, so we obviously have an allowance each year for making an ISA contribution. So would you mind sort of explaining to everyone a little bit more about how much that is and how to use it and so on?
Yeah, sure. So typically there are four main types of ISA for individuals, for adult individuals. So you've got the cash ISAs, you've got stocks and shares ISAs, you've got innovative ISAs, and you've got the lifetime ISA. So the allowance for the first three are 20,000 per year. So 20,000 per individual is the ISA allowance for 23-24. For cash ISAs, that typically would be for shorter term funds and would be in banks and building societies. For stocks and shares, that's really where clients can look at leaving their investments a little bit longer, but accept maybe market volatility for those investments. You can only have one type of each ISA in each tax year, but you can mix and match up to that allowance threshold. So if you've got a bank account with a cash ISA in, you can top that up, but you can't have two cash ISAs in the same tax year for the same annual allowance. And there's stock and shares investments as well. So you could do 10 into each if you wanted to cover all bases. The innovative ISA is maybe a little bit more unknown. That's sort of peer-to-peer lending. So that's where the investment is with a lending account provider, and your funds are effectively lent out to businesses or individuals. It's pooled with other investors, and maybe a little less familiar. It's something that we don't outwardly offer, but it is an allowance that's available. You've then got lifetime ISAs. Now, lifetime ISAs are typically for clients between the ages of 18 to 40 that maybe don't already own a home or partly own a first property with somebody. There is a limit to the lifetime ISA of £4,000 per year. That's the cap, and that's part of that overall 20,000 limit. So if you were funding a lifetime ISA or funding it on behalf of a child maybe, or a young adult, then that £4,000 allowance would be part of the overall 20,000. Lifetime ISAs are interesting. They have a 25% bonus added to the investment the individual makes. If the funds are used to purchase a property, their first property, there is a cap on the property value of £450,000. And it has to be open for a minimum of 12 months as well for any bonus to apply. So it can be very helpful for those individuals, young adults funding their first home, but there are a few caveats. So and so if you come across clients maybe that are looking to buy their first home in London, that 450 cap may not be sufficient, so it may not be appropriate, but certainly in the main that's the way that is structured. The other element for ISAs as well are junior ISAs. So clients may well want to fund for children or grandchildren, and the junior ISA allowance for the current tax year is £9,000. That can be either a cash or an investment ISA, a really good starting point to get children onto the ladder of investing. As they get a little bit older, they may well take a keen interest in where their funds are placed themselves. So I always think that's a good education tip for maturing children. Once they turn 18, they are entitled to an ISA. It converts into a standard ISA in their own name. So just one point there would be, parents or grandparents have to be comfortable that the child is suddenly going to have complete control of those funds at age 18 to do whatever they want with. Having a 12-year-old son, you might just want to measure how much goes in there, but yes, certainly very helpful.
No, definitely, Debbie. And I think definitely the lifetime ISA is something that not many people really are familiar with. And I think it can also be used in a slightly different way. So if you already have bought your first home, it is something to consider as well. I know a lot of my clients are quite keen to talk about it because it's a bit of a pensions alternative, isn't it?
It is, absolutely. Yeah, you're quite right. So although you can open them from the ages of 18 to 40, if you've had ones, bonuses can carry on accruing up to age 50, and they can then be used for retirement. So if they haven't been used earlier on for a first property purchase, they can absolutely be used towards retirement planning, and those bonuses would still stand. So again, you're quite right, a really good addition to the pension pot as well there.
Oh, fantastic, Debbie. Thank you for explaining that so well. I don't know if you've had this as well, but I've had a lot more clients since the interest rates have gone up, thinking about doing cash ISAs versus stocks and shares. And I've even had a couple of people since the stock market's had a bit of a rally just before Christmas, where they've said, I've done my ISA for this year, but I did it as cash. Is there anything people can do when they're in that situation?
Yeah, absolutely. So if they've already done their ISA allowance in cash, the beauty of ISAs is they are very transferable. So if somebody has built up savings within cash while the markets have been a little bit volatile, and then think, oh, we'll have it, or we're due this correction in the markets, I really want to get into a stock and shares ISA, then absolutely we can certainly advise on transferring from cash to stocks and shares. So very, very transferable. The other option as well, so if just mentioning about volatility in markets, a lot of clients have also maybe had to dip into their ISA funds, either maybe to help with increasing cost of living, mortgage payments, or even helping their children with property purchases or mortgage payments. One thing I would point out is the ISAs that we recommend and advise upon are all under the category of a flexible ISA. So I mentioned earlier there are 4 types of ISA for adults. Actually, a flexible ISA is just a type of cash or stock and shares ISA. And what it means is, if somebody's dipped into their ISA savings during that tax year, then they can put back that money in the same tax year. So they're basically maintaining their allowance. So for example, if somebody's had to take out £20,000, they can not only put in this year's 20,000 allowance, but they can repay back in what they've taken out, as long as it's within the same tax year.
Yes, that's definitely one. I mean, I've definitely had a lot of my clients who've been dipping into their ISAs in a way that they haven't before. So it's really great to know that. And I think one thing I've also seen is clients considering withdrawing from their ISA, perhaps thinking about topping it up within the same tax year, but making sure they can make more pension contributions, because pensions are always a hot topic, but particularly in this tax year, they've been very much part of the conversations.
Yeah, definitely. And pensions, are really the first pot that as an advisor we would suggest clients to fund. And maybe sometimes clients feel that they have to fund personally, but if they are in a position where they are, the director of a business, as many of our clients would find themselves in that position, it may well be more tax efficient to fund from the company. I know, Sophie, you've had quite a lot of experience with that, haven't you? So maybe share a little bit more about how that could benefit.
Oh, definitely. So it's actually an article that's coming out in our next newsletter that I've written about a genuine client that I work with. And what happens when you make a company contribution is that it's taken off the profits before corporation tax is calculated. So that's going up to 25%. That's a great bonus. So you're saving 25%. Also, if it's money you would have otherwise paid yourself as a dividend or even as PAYE money, what you find is you're paying sort of, let's say it's high rate dividend tax, sort of 38.1%, which is quite a high level of tax to pay. So you're also saving that if you make it straight into the pension rather than directly to yourself. Now, that's been a really sort of big topic of conversation with some of my business owning and sort of higher director level clients, but also down to sort of general people and considering things like salary sacrifice as part of their sort of day-to-day planning, because actually they can use things like that to be a little bit more tax efficient with their contributions.
Yeah, it's a real win-win, isn't it? And tax saving with pensions, there are many caveats to that. And of course, the pension funds themselves are particularly flexible. The assets that clients can hold in pensions, and also, so if I don't know whether you've experienced this, but clients where they take on borrowing within their pension funds.
Oh, definitely. So that's the big thing, isn't it? So I have a lot of clients who are slightly more traditional in the sense they love property. I think as a nation, we love property, whatever kind of property it is, and that ownership and that control. And one thing that we've definitely seen an uplift in, Debbie, is the number of people who want to buy property within their pension. And I know you've had some experience with this recently, haven't you?
Yeah, absolutely. And it's interesting because, particularly if they are business owners, they can make that company contribution, make that tax saving within the business, grow their pension pot. And then, with that gearing, with that borrowing that typical SIPs or SASs have available, they can borrow up to 50% of their value. So in essence, if they are looking at maybe purchasing their own commercial premises or buying new commercial premises, it's a great vehicle. And of course, then if they're retiring or exiting the business, that asset stays within their pension plan. And maybe as a high earner, they may be limited to the contributions that they can make into their pension. However, if it's a property asset and it's rentals that are going in on a regular basis, that's a great form of regular contribution and also gives a pension that liquidity as well, which is really important.
You're absolutely right. And I've even had clients buying it from themselves. So they might own it personally and then sell it to their pension fund. So it doesn't necessarily have to be a new property or anything like that. There is a lot of opportunity there. And especially if it comes to people who are looking at selling the business in the future and they don't necessarily want to be sort of owning that property within the business, it can give them a lot more flexibility and opportunity.
Absolutely, absolutely. And again, with pensions, as with ISAs, one of the biggest advantages are the fact that the funds or the assets grow free of the normal tax treatment of the assets held outside of an ISA or a pension. And I think that's really key, particularly as we go into 24-25 tax year, because as we know, so the capital gains tax allowance is dropping again, isn't it?
It is. So at the moment, if you sort of are in the process of selling something and there's going to be a gain on it, you've got a £6,000 limit. Now, last year that was £12,000. And from April, it's going to be £3,000. So it's been absolutely chopped into a third. And really, £3,000 of gain is not a huge gain. So it's one thing that we've had a lot of clients that I've definitely been speaking to who are thinking, actually, let's pay this now, because also capital gains tax is a slightly lower rate than sort of when it comes to personal income tax in general. So you're looking at sort of 10% and 20%, unless it's residential property where it's 18 or 28% at the lower and higher rates. And I think suddenly if you've got to pay another 28% on £3,000, it makes quite a big difference, doesn't it?
Oh, absolutely. And, I think in terms of this podcast being all about tax year end, I think it's just crucial that everybody has that little bit of a reminder and a recap. It's who knows what, years hence are going to give us allowances. So we can only deal with the one we're in at the moment. And I think, planning for the end of this tax year is going to be key as we move into 24, 25. I think as well, if we just look at, sort of pensions, just while we're on a tax angle, pensions, of course, are exempt from inheritance tax planning as well. So if we want another reason why pensions are a great vehicle, all of the asset classes that can be in a pension, be it cash, all of those assets, or commercial property, I should say, all of those assets are, outside of the estate once they're in that pension wrapper. ISAs are still within the client's estate, but of course, just one reminder on ISAs as well is those inheritability rules, which I didn't mention earlier. So of course, if you've got two spouses with ISAs, one spouse passes away, the other spouse can actually inherit the banding, the value within their own personal ISA allowance. So again, more than happy to speak to clients or answer any questions beyond this podcast, but quite a few healthy tax planning rules around all of those.
Definitely. And sort of going back to pensions and being a bit of an inheritance tax planning tool, the other thing that I've seen a lot more people utilizing, and it being one of the conversations that we're having a lot more of, is the fact that with the allowance being 60,000 for this tax year, you can use your 60,000, but then you can also look back at the last 3 tax years where it was 40,000 and look at the potential of utilizing that if you haven't already, with the only caveat being that you've had to be a member of a UK pension scheme in those 3 years. So this tax year, you've got the ability to be able to pay in £180,000 into your pension.
Gosh, and that's a substantial contribution and very meaningful. And again, can really help people build that pot for retirement. And the flexibility, obviously, within pensions is something that, we're very keen to speak to clients about. As I say, it's not just the tax advantages, it's the flexibility of income and how they can take the liquidity from their pension in retirement.
Definitely, especially now within this tax year, they've removed the 55% lifetime allowance tax charge. And also there is no such thing as the lifetime allowance at the moment. Who knows what that'll mean later in the year, because we might have a new government. But as it stands at the moment, with this tax year, there's no lifetime allowance tax charge. So it's always something to be aware of if you have got quite a large pension scheme.
Absolutely, that can make a real difference. And of course, the tax-free cash within the pension is still subject to those previous limits, but where clients couldn't make contributions because of that LTA cap previously, it has opened a new opportunity for us to have discussions with people about what they want to do.
Definitely. And I think we've covered quite a lot in quite a short space of time, but all the sort of main points really around sort of all the tax planning you can do. My last point would just be, as I always do, go on about my tax efficient investments, which is your EIS, your enterprise investment schemes, your VCTs, your venture capital trusts, and business relief. Business relief's not so tax year end important, although you can hold AIM shares, which are qualifying for business relief within an ISA, but you have also got VCT season, as it's called at the moment, where people are raising money within the VCTs, and it tends to be quite a short window, but it's always worth reviewing. You get 30% income tax from a VCT, and with an EIS you also get the same benefit as 30% of income tax back, but they are very high risk and specialist investments, so you definitely need to speak to your advisor about those, especially when it comes to sort of trying to just use the tax planning element, because as we're recording this, it's just getting very close to when you've got to pay the tax bills. So I'm sure everyone's very conscious of how much tax they've paid in the last year.
Absolutely. And as always, liquidity is key. Again, all of the investments and funds that we advise upon have that degree of liquidity as well. So subject to the wrapper limits and the rules. But yeah, Sophie, that's, I think, in terms of tax year end, that was a little bit of a whistle-stop tour of the hot topics and themes that are important to, or we're talking to clients about at the moment. I think, in terms of this series of podcasts, you can find out more about other hot topics and other client interests throughout our podcast episodes. They are available via our Spotify and YouTube channels. But of course, if you have any questions, there's always the old school method of just getting in contact with your financial advisor, reaching out to us all via our website. And yeah, we're more than happy to help, assist and answer any questions directly. So that's everything from me. Sophie, anything else from your side?
Just to say, we are also talking about real case studies in our newsletter, so actual clients that we've helped, and I always think that can break down some of the more complicated situations, so do check those out as well. We do sort of email them out to people, and if you want to be added to any mailing list, then just ask us. We're more than happy to send them out to you. But thank you so much, Debbie. I found this very useful. It's always a good reminder at this time of year that we've got a bit of a push for the next few weeks, especially with a March Easter in mind. So thank you so much for making time, and thank you all for watching and joining us.
Thank you. Bye-bye.